You know, every great company out there, from the tiniest startup to a global giant, what do they all have in common? They need money. Money to survive and money to grow. So today, we're going to follow the money. We're going to see exactly how a simple idea finds the cash it needs to become a name you know and trust.
It's the classic story, right? Some brilliant idea sketched out on the back of a napkin over coffee. But how does that actually happen? How does a doodle transform into a real, thriving business that employs thousands of people and maybe even changes the world? What's the secret sauce?
Well, the answer is pretty simple. It's capital, money, funding, whatever you want to call it. Think of it like fuel for a car. It powers a company through every single stage of its life. Without it, even the best ideas in the world are just stuck in the garage. Okay, so to really get how this works, we're going to use a roadmap. It's called the business life cycle. As we follow along, we'll see how a company's need for cash just totally changes as it goes from being a scrappy little startup to a massive, mature industry leader.
All right, let's kick things off right at the beginning, the startup phase. This is where it all begins. That big idea needs to find its first believers and, let's be honest, its first dollars.
So in these super early days, you don't have a ton of options. A lot of founders start by draining their own savings or turning to what's known as the 3 Fs: family, friends, and, well, fools. These are the people willing to take a huge chance when no one else will. And you'll see commercial banks on this list, but yeah, that's pretty rare for a brand new idea. They're just too conservative. The real outside money at this stage, that comes from some pretty specialized investors.
And this quote right here, it just hits the nail on the head. It perfectly captures how professional investors think. If your own inner circle, the people who know you best, won't put their money on the line, why on earth would a stranger? It's like the first, most basic proof that you might actually have something.
So who are these strangers we're talking about? Well, 2 of the big ones are angel investors and venture capitalists, or VCs for short, and you can see here the real difference between them is all about scale. Think of an angel as a wealthy person, or maybe a small group, writing a check for a really early, really risky idea. VCs, they're the big leagues. Professional firms managing huge pools of money, investing larger amounts, and often funding companies in stages as they hit their goals.
Okay, so why would anyone take on this kind of insane risk? I mean, it's a huge gamble. Well, it's because the potential payoff is just as huge. See, they know that for every 10 companies they back, maybe 9 of them will completely flame out. So that one winner, it doesn't just have to be a success, it has to be a massive success. It has to pay for all the losers and still make a profit. That's why they're chasing these absolutely wild returns of 60, even 100% a year on their big wins. It's a very high-stakes game.
Okay, so let's say our little company made it. It survived the startup phase, it's got a product, it's got customers. Now it's time to hit the gas and grow. But scaling up, that takes a whole new level of fuel.
And guess who's suddenly interested? Those same banks that wouldn't touch the company with a 10-foot pole before, now that there's a track record, some income, some assets they could take if things go south, now the company is a much safer bet. But, and this is a big but, getting a bank loan isn't always what it seems. The devil is absolutely in the details.
Let's break down one common type of business loan you might see, the discount loan. The idea itself is simple, but it's kind of sneaky. The bank figures out the interest you owe for the year, and they just subtract it from the loan right from the get-go. So you walk away with less cash than you thought you were borrowing.
Okay, let's put some real numbers on this to see how it works. Imagine a company needs $2 million, cash in hand. The bank says, sure, we'll give you a 1-year discount loan at 9.5%. But here's the twist. To get that $2 million, the company doesn't borrow $2 million. Nope, they have to sign paperwork for a loan of over $2.2 million. Why? Because the bank instantly skims its $209,000 in interest right off the top.
And here's the kicker. The company paid almost $210,000 in interest, right? But they only got to use $2 million, not the full $2.2 million. So when you run the numbers, the real interest rate they're paying, what we call the effective rate, isn't 9.5%. It's actually 10.45%. The bottom line here is simple. You're paying more than the sticker price. It's a huge lesson for any business owner. That advertised rate isn't always the rate you actually pay. You have to understand the fine print to know what that money is truly costing you.
All right, now our company is all grown up. It's a major player and it needs massive amounts of cash for big projects, like building a new factory or going global. This is when they step into the big leagues, the public markets.
And when you get to this level, there are really two main paths you can take. You can either borrow money on a gigantic scale by selling corporate bonds, which is basically a giant IOU to the public, or you can sell off little tiny pieces of ownership in your company for cash. That's selling stock, usually through what's called an initial public offering or IPO.
Now, selling bonds isn't like asking a friend for a loan. It's a super formal, heavily regulated process. You've got to hire a big investment bank, get everything registered with the SEC, that's the government's financial watchdog, get your bond rated for risk, and then you have to market and auction it off to potentially thousands of investors. It's a whole thing.
And going public with an IPO? Just as complicated. Again, the company teams up with an investment bank to manage the whole sale. But this brings up a really critical question. How does the bank get paid? And who's on the hook if the stock doesn't sell as well as they'd hoped? This is where it gets really interesting, because the company has a choice to make. They can go with what's called a best efforts deal. That means the bank says, hey, we'll do our absolute best to sell your shares, but they don't make any promises. The company keeps all the risk, but if the stock goes crazy, they also get a much bigger reward. The other option is a fixed commitment. Here, the investment bank buys all the shares up front and guarantees the company a set amount of cash. The bank takes on all the risk, but the company gets a smaller, guaranteed payout. It's that classic tug of war between risk and reward.
Okay, and so we come to the end of the road, because eventually every business journey has to come to an end, one way or another.
And this usually happens in one of two ways. You have a successful closure, where a company is solvent, meaning it's worth more than it owes. They just decide to close up shop, sell off everything, pay their bills, and the owners walk away with what's left. Or you have the less happy ending. An unsuccessful company declares bankruptcy. They either liquidate, sell everything off to pay back whatever they can, or they try to reorganize and maybe come back in a different form.
So after this whole journey, what's the big takeaway? It's this: a company's funding strategy is never set in stone. It has to change. It has to evolve. The way you get money as a tiny startup is completely different from how you fund a global giant. It's not a one-and-done decision. It's a constant evolution to survive and thrive.
And that brings us to a really interesting question about the future. We've just walked through the traditional playbook, right? But technology is changing everything. With the rise of things like crowdfunding, where suddenly millions of regular people can act like mini investors, you have to wonder, is this entire business